We need to talk about the startup graveyard. You know the place I'm talking about.
Oh, I do. It is crowded.
It is absolutely packed with companies that had the big idea.
Yeah.
They had the disruptive tech, the charismatic founder, all of it. And then, 18 months later,
Poof. Silence.
gone. The domain expires, the LinkedIn updates stop, and they just vanish.
It really is the silent killer.
It is. Yeah.
We love to romanticize startup failure as, this big dramatic clash of visions or the market not being ready.
Right.
But usually, it's much more boring and much more lethal. It's the engine room. It's the finances.
Exactly. It isn't sexy. Nobody starts a company because they're excited about reconciling bank statements.
Yeah.
But it's literally the difference between life and death for a business.
And that's our mission today.
It is. We are unpacking a piece called Effective Strategies for Managing Startup Finances, published on Our Reflections. And I have to say, looking at the source material, this is not just accounting 101.
No, it's really not. It's a survival guide. It's written by someone who clearly understands that financial management, it's not just about hoarding coins. It's about resource management.
It's about having enough fuel in the tank.
Exactly. Enough fuel to get the car to the destination without the engine blowing up halfway there.
Okay, so before we dive into the 10 strategies, and we are going to cover all 10 because they interlock in a really interesting way, we have to talk about the author, Mihigo E.R. Anaja. His bio in the research pile was distinct.
That's certainly one word for it.
He calls himself the author of Time and Legacy, and my personal favorite, The Programmer Without Stress.
Which honestly sounds like a mythological creature.
Right. I have never met a programmer without stress.
It does imply a certain, a mastery over chaos, doesn't it?
Yeah.
But if you look at his track record, he sort of backs it up. He's written 9 books, over 200 computer programs.
And he runs the Aliflections platform, which is this huge ecosystem of marketing solutions, AI tools.
Yeah, he's got apps, Little Shark AI, a marketplace.
So when this guy talks about organization, he's speaking from experience, he's incredibly prolific, he gets the hustle. So let's take his 10 strategies and figure out how they move a business from barely surviving to actually sustainable.
And I think the best way to tackle this is to break it down. You don't do it all at once. Let's think of it in phases. There's, say, the foundation,
The flow.
the growth, and then the human element.
I like that. Let's start with the foundation, the non-negotiables. And strategy number 1 is create a detailed budget.
It sounds so basic, like something everyone knows they should do.
But the key word there is detailed. What's the difference between a detailed budget and, what most founders do, which is scribbling rent, $2,000 on a napkin?
The difference is reality versus hope. A lot of founders, they create a budget based on the best case scenario. They list all the money they hope to make.
But they're a little vague on the costs.
Super vague. Mihigo says you need to outline expected income and all expenses. He lists out operational costs, marketing, salaries, and overheads.
Overheads are the real killer. It's not just the rent. It's all those software subscriptions, the insurance, the coffee.
Exactly. But the key insight here isn't just making the list. It's that the budget is a living document. That's the phrase he uses.
A living document. Okay, what does that mean in practice?
It means you track spending against reality. If you make a budget in January and stick it in a drawer, it is totally useless.
Right.
You need to look at it in March and say, wait, we projected spending $5,000 on marketing, but we actually spent 10. Why?
It's a navigational chart. If you drift off course and don't look at the map, you're going to hit rocks.
Precisely. And that leads directly into strategy number 3, which, frankly, I think is the most common reason young companies get into all sorts of trouble.
Let me guess. Separate personal and business finances.
The cardinal sin.
I feel like every entrepreneur has done this at least once. You're out somewhere, you forgot your personal card, you just swipe the company card.
Or you pay a freelancer from your personal Venmo because it's just faster. Mihigo is really strict on this.
So why? What's the big deal?
It's about 2 things, clarity and compliance. First, clarity. I mean, if your personal grocery bill is mixed in with your server costs, you literally do not know if your business is profitable.
You're just muddying the water. You can't see the bottom.
Exactly. And then there's compliance. Tax season becomes an absolute nightmare if you're sifting through receipts, trying to remember if that coffee was a client meeting or just, a caffeine fix.
Okay, so what's the fix?
A dedicated business bank account, period. It simplifies everything instantly.
You're building a wall between you, the person, and you, the
And,
entity.
and that wall protects you. It's the whole corporate veil idea. Just treat the business like a separate person. You wouldn't steal money from a stranger's wallet to buy lunch, right?
Right.
So don't do it from the business account.
That's a great way to think about it. Which brings us to the most thrilling part of startup life. Strategy number 5, maintain accurate financial records.
The incredibly boring, incredibly essential part.
Receipts, invoices, bank statements. It just feels like busy work when you're trying to change the world.
But think about his title again. Programmer without stress. Where does stress come from?
The unknown.
Exactly. Stress is the IRS sending you a letter, and you have zero proof of your expenses. Mihigo links this directly to decision-making. If you don't record the data, you can't analyze anything.
So it's not just about keeping the tax man happy.
No, it's business intelligence. He says use accounting software or hire a professional right away. You need a dashboard. You need to know, hey, we spent 30% more on shipping this month. You can't know that if the receipts are crumpled up in your glove compartment.
The old shoebox method of accounting.
It never ends well.
Never. Okay, so that's the foundation. You have a budget, a separate account, and you're actually writing things down. Now we move to part 2, the flow.
Right, because money in a startup isn't static. It moves.
Which brings us to strategy number 2, monitor cash flow. Now, can you clarify this for us? Because budget and cash flow get used interchangeably, but they're very different.
Completely different animals.
Yeah.
Think of the budget as the map for the year, the plan. Cash flow is the gas in the tank right now.
Okay.
You can be profitable on paper, meaning you sent out invoices for $100,000 this month. But if those clients don't pay you for 60 days and you have payroll due Friday, you're broke.
You can die of thirst while waiting for the rain.
That is a perfect analogy. Cash flow is liquidity. Mihigo says you have to use cash flow forecasts to predict shortfalls. It's about looking ahead and seeing the iceberg before you hit it.
And he mentions a specific tactic here about invoicing.
Yeah. If your cash flow is tight, you need to tighten your payment loops. Are you waiting 90 days for payment? Can you offer a small discount for clients to pay in 15?
So you can solve problems without even making more sales.
You got it. Just getting the money in a door faster is huge.
So while we're watching the money trickle in, we also have to watch it pour out. Strategy number 4, implement cost control measures. Does this just mean stop buying the good coffee?
It's deeper than that. It's not about being cheap, it's about being efficient. There's a difference. Mihigo talks about regular reviews of expenses to identify where you can cut spending without killing quality.
Okay, so give me an example from the source. How do you do that?
He lists 3 things. First, negotiate better deals with suppliers.
People forget they can do this. They see a price online and assume it's set in stone.
All the time. Just because you paid X for your software last year doesn't mean you have to pay X this year. Call them. Ask. The worst they can say is no.
And the second one?
Cut unnecessary expenses. This is usually subscription creep.
The zombie subscriptions.
Exactly. The tools you signed up for 3 months ago that nobody uses. Kill the zombies. And third, optimize resource usage. Are you paying for a huge server when a smaller one would do?
You're making sure every dollar you spend is actually doing work. If a dollar is lazy, you fire it.
And that money goes straight to the bottom line without any extra work. It's the most efficient way to increase your runway.
That's a very persuasive argument. But there's one place the money must go. Strategy number 7, plan for taxes.
The Grim Reaper of the startup world.
Mihigo warns against unexpected liabilities, which is a polite way of saying getting a huge bill you can't pay.
It happens constantly.
Yeah.
A startup has a great year. They see $100,000 in the bank. They think, awesome, let's hire 2 more people.
They spend the money.
And then April comes and the government says, actually 30,000 of that was ours. And the company doesn't have it.
That's a death spiral.
It is. Mihigo's strategy is just simple discipline. Set aside funds specifically for tax payments. Treat it like it's not your money.
Because it isn't.
It isn't. Open a separate savings account, call it tax hold, and every time you get paid, transfer the percentage over immediately.
Do not pass go. Just move the money.
Correct. And, familiarize yourself with the regulations or get a pro. Oops, I didn't know. Does not work with the tax authorities.
Okay, so we've built the foundation. We're managing the flow. Now we want to get big. Part 3, growth and resilience. Strategy number 6, secure adequate funding.
This is where the dream meets reality. You can't scale on good vibes alone.
The source lists the usual options: venture capital, angel investors, loans.
Right, but, and this is the key linkage, you can't just walk into a VC's office with a cool idea and ask for a check.
No.
And this circles all the way back to part one. He says you need a solid business plan and financial projections. Investors want to see the records. They want to see the budget.
So if you skip strategy 1 and strategy 5...
You literally cannot execute strategy 6. They aren't investing in your idea, they're investing in your ability to execute.
Yeah.
And the records are the proof.
Due diligence is where sloppy finances go to die.
100%.
Yeah.
If an investor asks, what's your customer acquisition cost? And you have to guess, the meeting is over.
Okay, now strategy number 9 is one I find really interesting because I feel like it's debated. Build an emergency fund.
It is debated. The aggressive Silicon Valley view is often, cash is trash. Reinvest every single penny into growth.
Grow or die, right.
Yeah. But Mehigo takes a different stance. He argues for a financial cushion. And I think this comes back to his whole stress-free philosophy.
Because startups are volatile.
Incredibly volatile. A client might drop you, a server might crash.
Right.
If you have zero cash reserves, a single bad month can kill the entire company.
It's an insurance policy against chaos.
He calls it financial resilience.
Yeah.
And psychologically, you just make better decisions when you aren't desperate.
That's a great point. Money in the bank buys you the power to say no to bad deals.
Precisely. It buys you autonomy. And that autonomy lets you think long-term, not just survive the week.
Speaking of long-term thinking, strategy number 8 is evaluate and adjust financial strategies. This feels like the meta layer.
It is. It's the recognition that the map is not the territory. You don't just set these rules and forget them. The market changes. Your business changes.
And he lists specific metrics to watch.
He does. Profit margins, return on investment ROI, and break-even analysis.
Let's break down ROI for a second. Why is that so important for adjustment?
It's simple. Is this thing we're doing actually making us money? You might love your Instagram campaign. It might get lots of likes.
But the ROI might be terrible.
Exactly. If it costs you $500 to acquire a customer who only ever spends $50, you need to stop doing it. But you can only know that if you're measuring.
It's the feedback loop.
Right. Adjust based on performance data. If you're not measuring, you're just gambling. And you have to be willing to kill your darlings.
Sure.
If a product isn't working, the data will tell you. You have to listen.
So we have the system, we're funding it, we're adjusting it, but there's one final piece, part 4, the human element. Strategy number 10, seek professional financial advice.
The admission that you cannot do it all alone, and frankly, you shouldn't even try.
Founders struggle with this, I think. They think, I can't afford an accountant. Or they have the ego that says, I can learn this myself.
The reality is, you can't afford not to have one. Mehigo suggests consulting them not just for the math, but for the strategy.
What's the value add there? Beyond just filing the forms correctly.
They see around corners. A good financial advisor knows about tax credits you've never heard of. They know how to structure funding to avoid dilution. They help you avoid the common pitfalls because they've seen 100 other startups fall into them.
So you're buying their experience so you don't have to learn the hard way.
It's a shortcut. It lets you focus on what you're actually good at,
Yeah.
building the product, while someone else makes sure the house doesn't burn down.
And if we look at the author again, Mehigo, I mean, look at what he's built. Owl Reflections isn't a blog. It's a complex software company.
It is. We checked the contact info. The plus 250 country code suggests Rwanda, but he's clearly operating globally. He has a marketplace, multiple apps.
He's running a complex machine.
Right. So when he says hire a professional, he's speaking as someone who probably has to manage multiple product lines, international currencies, the whole thing. He's not just theorizing.
That context really matters. These aren't just textbook rules. They're the operational manual for his own success.
Exactly. He's doing it.
So bringing it all together, we've gone from these super granular saving receipts, separating bank accounts, all the way up to ROI analysis and securing VC funding.
It's a whole spectrum. But the thread connecting all of it is sustainability.
And that brings me to the final thought I want to leave with everyone listening. We started with Mehigo's title, Programmer Without Stress.
Yes.
We usually think of financial discipline as this, I don't know, this restrictive, painful thing, a chore. I can't buy this. I have to do paperwork. It feels like a burden. But I think Mehigo is flipping that script completely.
How so?
Well, think about it. If you have an emergency fund, you don't panic when a client pays late.
Yeah.
If you have a clear budget, you don't lie awake wondering if you can afford to hire someone. You know if you can.
If you have a pro doing your taxes,
Yeah.
you don't wake up in a cold sweat in April.
Exactly. That's a fascinating way to look at it. The ultimate goal of all this discipline isn't just wealth, it's peace of mind.
Right.
Is your financial strategy actually a stress management strategy? Because if you follow these 10 steps, you're not just building a company, you're building a life where you aren't constantly in crisis mode.
And that's the only way to really be a programmer without stress. You build a system that handles the stress for you.
You outsource the anxiety to the spreadsheet.
Outsource the anxiety. I love that.
So, to everyone listening, check your receipts, call your accountant, and maybe, just maybe, start building that emergency fund today.
Keep learning.
Keep organizing. We'll see you in the next deep dive.